We don't do tax returns here. If you call me and ask me questions about child tax credits or earned business income, I have no idea. I'm going to refer you back to your CPA. But anything real estate depreciation, real estate taxation, we're happy to help. Please use this as a resource, guys. We just want to be a resource for you guys and help save you some tax dollars.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 430. As real estate investors, we are always looking for ways to save on our yearly IRS tax bill, and cost segregation is one of the most powerful methods available to us. Today, we have Erik Oliver from Cost Segregation Authority on the show. Erik will be explaining how you can leverage cost segregation to save on your taxes, as well as energy credits that you need to be aware of. Erik, welcome to the show.
Thanks for having me, Brian. I'm excited to be here.
For our audience who doesn't really know what cost segregation is, give us the 101 on what we're talking about today.
Cost segregation really is just accelerated depreciation on your real estate assets. So one of the great benefits of owning real estate is some of the tax deductions that are available to you. And one of those large deductions is depreciation. Now, normally residential rental properties get depreciated over 27 and a half years. Commercial properties get depreciated over 39 years. So just to make the math easy, let's say you've got a $275,000 single family home. Essentially, you're going to take that, divide it by 27 and a half years, and you're going to get a $10,000 write-off every year for the next 27 and a half years, which is great. You know, we love $10,000 write-offs. However, I may not own my property for 27 and a half years. I want my deductions now. So instead of taking even deductions over the next 27 and a half years, what if I could front load or take larger deductions in the early years? And the way you do that is through cost segregation. And just as the name implies, we're going into the building, the structure, the residential rental in this case, and we're going to segregate the different components of that building. So for example, when you paid $275 for that building, you didn't just buy the land and the walls, you also bought some appliances, you bought some flooring, you bought some countertops, some cabinets, you bought a driveway, you bought an irrigation system. All of these things, according to the IRS, should be depreciated at a much faster rate than 27 and a half years. The challenge, Brian, is, as you know, you give that closing statement to your tax preparer. They don't know the value of those different components. They just know you paid $275,000 for this whole asset. And so that's where a company like ours comes in, and we identify and put values to all those different components within your building, which allows your tax preparer then to depreciate your carpet over 5 years, which is the correct depreciable life of carpet, versus clumping everything together and depreciating it all over a long term. So that's really the whole idea behind cost segregation, is just accelerating those deductions in the early years and taking those deductions at a faster rate.
How do you do that? Like if you're doing a cost segregation report, what does that look like, and how do you go through and break out all the components?
The IRS there's a depreciation book. It's thousands and thousands of pages that tells you how to depreciate just about anything that you could imagine. And the challenge is tax preparers, we're kind of general practitioners. We know a little bit about a whole array of subjects, but we can't dive deep into this couple thousand page book of depreciation. So a cost segregation company will come in, they identify those components through a couple different methods. One is on new construction, oftentimes you have a breakout of all the different costs of your building. And so we'll go through those thousands of lines, everything from doorknobs to electrical outlets to molding to carpentry, all those different lines, and we'll identify what the short-term assets are and break those off into different buckets per se. That's one method. That's on new construction. On existing construction, meaning you go buy an existing building that was maybe built in 1980, you buy it here in 2024, we don't know what the value of that carpet is in that building. And so we have to use an estimation approach. So we use construction software that allows us to estimate what carpet in that market at that time would cost, and that's how we're able to reconcile the costs. So our deliverable to your tax preparers, it's about a 40 or 50 page report, but it has everything broken out, the amount, the value, and that's what they're using to upload into their tax software so they can take advantage of these deductions.
Is this something that a person could do on their own, or do they absolutely have to hire someone like yourself to break it out for them?
Technically, you can do it on your own. There is no governing body for cost segregation. You don't have to have a specific license to do cost segregation. You don't have to be a tax preparer. You don't have to be a constructional engineer. However, the IRS does issue an audit guide to their agents that shows them or tells them what to look for in a study. And one of the main factors is, in order for it to be considered a qualified study, you do have to have expertise in both tax knowledge and construction knowledge. So the reason for that is your typical tax preparer, they've got the tax knowledge. They just don't know, they don't have the construction software, the construction understanding to understand how to break down a building, how to reverse engineer a building and put values to that. So the short answer is no, you don't have to have any kind of license or anything. The long answer is if you want it to be audit proof, you probably should have a qualified company do it. The reason for that is if you ever get audited, they're going to ask for the methodology. So they're going to say, okay, Eric, you've got the parking lot as 4-inch asphalt. Why did you use 4-inch asphalt versus 6-inch? And you better have a methodology on why that's 4-inch asphalt versus 6-inch and why that value, why you came up with that value. And so I have seen some horror stories, I will be honest with you, where tax preparers will just take kind of some easy numbers and say, okay, I'll give you a live example. CPA friend of mine called me and said, Eric, my client's done a casual cost segregation study. And I'm thinking to myself, what in the world is a casual cost segregation study? And he's like, well, I just inherited this client. I got their depreciation schedule. And on the schedule, it says appliances, 12 grand, parking lot, 40 grand. And what the prior tax preparer had done was just put some arbitrary numbers to those things because there were appliances in the building, but how they valued those at exactly $12,000 is beyond me. Number one, don't ever use a whole number with the IRS. That's a red flag if you just got $12,000 on the depreciation schedule. But what happened is the CPA thought they were doing their client a favor because they were able to take these deductions and write them off quicker. And what we found when we looked at that building is they grossly understated the value of those components. And so the money they would have paid to have a cost segregation study done, actually, we redid it for this client. We did an actual study. We came up with $80,000 of additional deductions, which again, if you're in a 30% tax bracket, that's a $24,000 tax savings that they would not have otherwise had by just taking these arbitrary kind of rule of thumb numbers and plugging them in. So definitely worth having an actual engineering-based study done versus just kind of throwing some numbers on your depreciation schedule to try and get a quick write-off.
Talk about the IRS. I mean, what is the IRS's stance on cost segregation reports? I mean, obviously it's part of the tax code and everything, but do they target it? Do they come after it? What are some of the red flags that they look for?
The IRS is part of cost segregation is part of the tax code. They actually, like I mentioned, they issue an audit guide. So there's an audit guide that comes out that tells their agents how to review these studies. Was just last year the year prior to that, the end of 2022, they had the first major revision to the audit guide. And in there's a quote that says it's expected that real estate investors are going to accelerate their depreciation. So that tells me the IRS is aware of it. They're actually, with some of the changes to the tax law that we'll touch on back with the Tax Cuts and Jobs Act, things like bonus depreciation, it made cost segregation even more powerful. And more investors were starting to use cost segregation. So the IRS is aware of it. They expect you to do it. However, they do want you to do it right. They don't want you to just take a rule of thumb approach and throw some numbers on your depreciation schedule unless you can substantiate those numbers. So in the audit guide, there's 13 steps that will designate a qualified study. Things like making sure there was a site visit. We actually will go visit each property so we can see that there is in fact carpet. We'll measure how much carpet. We'll see how many linear feet of cabinets there are. Those types of things. So you got to have a site visit. The other thing that they oftentimes will look for is how our payment plan is structured. We're not allowed to charge the investor based on the tax savings that we save them. Well, for obvious reasons, we're going to be super aggressive if we get you a big tax savings and you have to give us 10% of that. So it's always a flat fee. So there's certain things they look for. However, they're not auditing them at any higher rate than they're auditing a normal tax return. So I've been doing this for 7 years now. The company that I work for, Cost Segregation Authority, we've done over 28,000 studies. We've been involved in just over 20 audits in those 28,000 studies. And not a single one of those audits was triggered by the cost seg study itself. There was something else in the return. They then notice on the depreciation schedule that you've taken accelerated depreciation, and then they will ask to see a study to back up those numbers. And you better have a study or some kind of documentation to quantify and substantiate those numbers. So the IRS accepts it. It's actually the correct way, believe it or not. If you're not doing cost segregation, you're actually doing it incorrect because you're depreciating your carpet over 27 and a half years, which is incorrect. Now, the IRS isn't going to send you a notice and say, hey, you have a bigger deduction than you took, because that's just more money in their pockets and they don't want to make you aware of that. So they're not going to come out and tell you you're doing it wrong. But in actuality, you're actually doing it incorrect if you're not segregating those costs when you buy a piece of real estate into the correct buckets, because you're depreciating them over the incorrect useful lives.
That brings up the question. I mean, what size does your property need to be in order to justify the cost of a cost segregation? I mean, if you just have a single family, should you do a cost segregation, or like, does it need to be a multifamily property?
You know, if you would ask me that question 7 years ago, I would say it needs to be over about $500,000 of what we call depreciable basis. Now, your depreciable basis is your purchase price minus the land value, because land is not depreciable. So usually that's somewhere around 20%, depending on what part of the country you're in. It could be anywhere from 5% to 70%, depending on the part of the country, but usually around 20 to 30%. So your depreciable basis should be, had you asked me that question 7 years ago, I would have said 500,000. Now, there's been some changes to the tax law, specifically with the Tax Cuts and Jobs Act of 2017, 2018, where they enhanced what they call bonus depreciation. So we should probably touch a little bit on bonus depreciation, because bonus depreciation basically puts cost segregation on steroids and makes the benefits even larger. So bonus depreciation, the IRS, the government has used bonus depreciation for a number of years to stimulate the economy. They say if you go out and buy, in the past, you had to go out and buy a brand new bulldozer, for example, and if you spend $1 million on that bulldozer and they were offering what they call 50% bonus depreciation, you would get to write off $500,000, or half of 50% of that bulldozer, all in year one. The other 50% gets spread out over the useful life of that bulldozer. So the idea is to stimulate and encourage people, hey, go buy stuff and you're going to get these huge tax write-offs. So if the economy is doing well, they'll lower the bonus depreciation. If it's not doing well, they'll increase bonus, again, to encourage people to go out and buy stuff. So how does this relate to real estate? Well, when you buy a building, you're buying some carpet, you're buying some countertops. In order to be eligible for bonus, those assets have to have a useful life of 20 years or less. Now, if you don't do cost segregation, your asset, remember, is either a 27.5-year asset or a 39-year asset, which means it's not eligible for bonus. However, if you do cost seg and you break it down into 5, 7, and 15-year buckets, all of a sudden those 5, 7, and 15-year buckets are eligible. And the big enhancement of 2017, 2018 with the Donald Trump was our president, Donald Trump owned real estate. And when he revised the tax code, it was very favorable to real estate investors. And so the big change was they increased bonus at the time from 50% to 100%. That was the first big change. The second big change, which I think was even more important, was, if you recall, I said you had to buy a brand new bulldozer. You couldn't buy a used bulldozer. It had to be brand new equipment. They added 5 words to the tax code that says new to you, the taxpayer. So now, if I go buy a used bulldozer, that's new to me, the taxpayer, and all of a sudden I'm eligible for bonus. And so where this has a huge impact on real estate investors is now you're eligible for bonus on assets that have already been built. So you can go buy an apartment building or a single family home that was built in 1980, do a cost segregation study, identify the 5, 7, and 15-year assets, and all of a sudden you get 100% bonus on those assets. And we usually segregate, Brian, around 30% of a building's value or cost into those shorter assets. So if you buy $1 million building, it's not uncommon to get $300,000 or 30% of that allocated to those short asset lives, things like carpet, countertops, etc., that 300,000, if it's eligible for bonus and it's 100% bonus, you're writing off that whole 300,000 in the first year instead of depreciating it over 5, 7, or 15 years.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Bonus depreciation, as we speak right now, it's February 7th, 2024. And there's a question out there as to whether they will improve or extend bonus depreciation. So talk a little bit about that.
Back with the Tax Cuts and Jobs Act, the bonus depreciation was at 100% for any assets placed into service between 9/27 of 17, so September 27th of 17, and 12/31 of 2022. Starting in 2023, they lowered it from 100% down to 80%. Here in 2024, it lowers to 60%. 2025, it's 40%, and it phases out 20% each year until 2027 when it's down to 0. Now, there was a bill that has entered into Congress. It actually passed through the House. It's sitting in the hands of the Senate right now. And the idea is to extend 100% bonus all the way through 2025. So they would actually retro date it back to 2023. So as you said, we're here on February 7th of 2024. It's very important that the Senate gets their act together and gets this thing passed because people are already starting to file their taxes for 2023. And this could impact those taxpayers if they bought a property in 2023, had a cost seg study done. If this bill gets passed, they'll now receive 100% bonus versus 80% bonus. So we'll have to wait and see. Check with your tax preparer when this episode comes out. There may be some changes to the law. My hunch is this will get passed. It was a bipartisan bill that got support from both sides. There was some child tax credits that were tied on to this bill. So the Democrats like the child tax credits. The Republicans like these business incentives. And they were married hand in hand, so it should get passed. It went through the House. I can't remember the exact number. It was like 370 votes to 60 or something. So it should get passed through the Senate. My guess is it'll get passed here by the end of this month, the end of February, but we'll just have to wait and see. But it could be huge for investors.
Going back to the question about who should do cost segregation, you were saying 7 years ago, you'd say, well, you got to have a $500,000 in a depreciable basis to begin with. What's your answer now?
My answer now is probably lowered because of that bonus. So now let's take a $200,000 single family rental, which I don't know, depending on your market, may be hard to come by these days, but let's say you do have some available in that price range. $200,000 of depreciable basis. If we segregate that and we find 30% of short asset lives, that's $60,000. Yeah, $60,000 of depreciable basis in those short asset lives. And if we get 100% bonus on that, that's a $60,000 write-off against your income. If you're in a 30 or 35% tax bracket, that's an $18,000 to $20,000 tax savings. Now, I will say there is a cost to these studies, and so you want to make sure that your tax savings far outweighs the cost. The cost on a residential rental for an engineering-based study is usually around about $3,000. So you pay $3,000, but if you save $20,000, that's a good investment. So that's kind of the threshold. Anything less than that, I think, is probably questionable because the tax savings might not outweigh the fee of the study, depending on your tax bracket. But usually I always will advise clients anything over about $200,000, at least have somebody run a quick analysis to see what the potential tax savings would be. And then obviously consult with your tax preparer to see if it makes sense for you to move forward.
So, Erik, how about the duration of how long you've held that property? Does it matter whether it's a new acquisition, whether, being an existing property or not, or if you've had a property for 10 years, is it still worth looking at it through cost segregation?
The great thing about cost segregation is the IRS actually allows us to go back and look at properties that have already been on the books. So let's say you bought a single family rental in 2017. You had never heard about cost segregation, or maybe you had heard about cost segregation, but maybe you didn't need those additional deductions in 2017. You can actually do cost segregation this year for 2023, because we're still in the 2023 tax period. You can do it for 2023 without having to amend any prior years. There's actually a form that's required. It's something that we provide as part of our service. It's called a 3115 change in accounting method. But this is what I was stating earlier. On that change in accounting method, you're telling the IRS, hey, I've been depreciating my building over 27 and a half years. I'm now going to change how I depreciate that. I'm going to accelerate my deductions. And you're actually checking a box on that form that says you're going from an impermissible method of depreciation or an incorrect method to the correct method. And here's the difference in those numbers. And you get to bring all that missed depreciation forward, drop it on your current tax return without having to amend. So that's one of the great tax planning opportunities with cost segregation is you don't have to do it in the year you purchase the asset. So you can kind of pick and choose. There's not a lot of deductions out there that I'm aware of where you can pick and choose what year you get to use those deductions. So again, if you don't have a lot of income this year, you buy a property, just keep that cost segregation report in your back pocket. Don't play that card this year. Wait till you have high income, and then you want to play that card when you have high income. So use the deductions from the cost seg study to manage your tax brackets. And that's a great tax planning tool that is available through cost segregation.
People who might be listening to this and saying, well, I don't need to write off all 100% of the components this year because I don't need the tax write-offs. You're saying that there is the possibility to kind of wait and hold it until you do need it. But if you do take it and you don't use the full amount of the write-off, does it carry over to the following years?
It does, yes. So the depreciation that's generated, you'll never lose it, but actually it carries forward indefinitely. So let's say I make $50,000 of income this year. I do a cost seg study. I generate a $150,000 deduction. I'll offset my $50,000 of income, pay no tax this year. And then next year, I'll have $100,000 sitting in that bucket that I can use towards my first $100,000 of income next year. So yes, the answer to your question is it does carry forward indefinitely if you can't utilize it all this year. There's a second piece to that question, Brian, that the IRS actually allows you to opt in or out of bonus depreciation by class life. And what that means is you can make the determination that I'm going to take bonus, that 100% bonus on my 15-year assets, but not on my 5-year assets. So what that means is you're spreading out your 5-year assets over 5 years, and you're taking all of your 15-year assets in the first year. And the reason you would do that is you maybe only plan on holding the building for 7 years. So you're going to want to accelerate those 15-year deductions, but you don't need all that depreciation in year one. So you're going to spread out your 5 years. So there's a lot of it's almost like you can tailor your deduction to what it is or how you're trying to maximize your savings with the help of your CPA. There's boxes on the return that says, hey, let's opt out of bonus at this asset class. Let's opt in at this asset class. And you can kind of tailor that deduction to ensure that you're maximizing your tax savings.
Can you explain then as well the concept of depreciation recapture? Because when someone sells the property, the IRS does want some of that depreciation back. Can you explain how that works and what they should consider there?
When you sell an asset, you pay two types of tax. You pay capital gains tax and you pay depreciation recapture. And the depreciation recapture is calculated based on how much depreciation you've taken. So I'm sitting here saying, hey, front load, take all this depreciation up front. And sometimes tax preparers will say, well, Erik, isn't this just a timing issue? If I take all this depreciation now, don't I just have to pay it back when I sell the building in 5 years? And the answer is no, you pay some of it back, at a lower rate and you save the spread. And I'll back into an example because I think it makes more sense. But let's say you buy a building for $1 million, you sell it 5 years later for $2 million. If you don't do cost segregation, you're telling the IRS that everything in this building has doubled in value. My land has doubled in value, my walls have doubled in value, and so has my dirty, nasty carpet that's 5 years old. It's doubled in value. Well, that doesn't make sense. Carpet doesn't go up in value, carpet goes down in value. But when you don't break the carpet out of your building and you just have everything lumped together as one big asset, you can't pull that out of the sales price. And so, as I mentioned earlier, carpet's a 5-year property. Carpet's a 5-year asset. So what is the carpet worth after owning your building for 5 years in that example? What's the book value? Zero. Has zero book value. So why are you telling the IRS that your carpet doubled in value and then paying tax on that? What you should be telling them is, yeah, my land and my walls have doubled in value, but my carpet certainly hasn't doubled in value. So again, to reiterate, you take your deduction this year by doing the cost seg study against your ordinary income. So let's say I'm in a 35% tax bracket. I'm taking the deduction today against income that's taxed at 35%. I'm paying back some of that in 5 years when I sell it at a 20% capital gains rate, or at most a 25% recapture rate. And I'm saving that 10 or 15% difference. And so that's the whole idea behind cost segregation is take your deduction now, pay back some of it at a lower rate at a future date, and save that spread.
So I'm hearing you say that for those who are concerned about cost segregation and then having to pay depreciation recapture when they sell the property, you still come out ahead by doing the aggressive depreciation while you're holding the property.
Yes. Actually, you can hold it for 1 year, over one taxable year. Now, if you only are holding it for 1 year, the basis needs to be about $500,000 or greater to make this rate arbitrage work. But even if you only hold it for 1 year, I bought it in 2023 in December, I sold it December of 2024. Even if I do cost segregation in that scenario, I'm taking the deduction at 35%, paying back some of it at 20% or 25% and saving the spread. And so even on a 1 year hold, an asset of about $500,000 is kind of the break-even point in that scenario where you're going to sell it in a year. But even on an asset at $500,000, you're still going to come out a couple $1,000s ahead by doing cost segregation.
Tell us what we need to know about energy credits and what might be available this year.
So there's 2 energy credits that everyone should be aware of who's investing in real estate or developing real estate, because they are probably 2 of the most underutilized deductions and credits that are out there. So remember, the IRS uses the tax code to kind of incentivize their objectives. So what they're trying to do is obviously push green energy. And so there's 2 deductions and credits to be aware of. The first one is called 45L. So the 45L is a tax credit. Now, this is a dollar for dollar tax credit on the construction of energy efficient dwelling units or residential units. And it could be as high as $5,000 per unit. So if you build a fourplex and you have a third party come in and identify that that fourplex is energy efficient according to the IRS standards, you may be able to take a $5,000 credit or $20,000 total on that fourplex as a tax credit. Remember, credits come right off the top of your tax bill. So that's the first tax credit to be aware of. Again, called 45L. It's for residential units that are considered energy efficient. You're going to have a third party come in and issue certificates. They're going to look at things like the HVAC, the insulation, the factors on the windows to see how energy efficient the windows are, those types of things. They'll run it through a modeling software, and then they'll issue the credits if it meets the criteria.
You can tell I'm taking notes here because we're just finishing up construction on a 120 unit apartment building. Would that qualify for 45L?
Absolutely. So you take 120, you're going to get either a $2,500 credit per unit or a $5,000 credit, depending on what level of energy efficiency there is. And I will tell you, Brian, it's almost hard not to qualify for these credits. With the building codes that are in place in most counties and the materials that are being used today, you really have to try not to qualify for these. It's really hard not to. So definitely worth looking into if you've got whether you're building single family homes or you're building multifamily apartment buildings. These go extremely underutilized. The nice thing is you can actually go back 3 years. So if you built anything in the last 3 years, you can go back and claim those as well. But definitely something to look into. That's the first one. The second one is something called 179D. Now, 179D is typically for commercial buildings, so not so much residential, unless it is a residential building residential building over 3 stories, then it may qualify for both the 45L and the 179D. But typically the 179D would be for your commercial space. Now, this is not a credit, this is a deduction. So it's not quite as powerful as the credit, but still very powerful. And it could be as much as $5 per square foot for the construction of that building. So if you build a 10,000 square foot commercial space, you may be eligible for up to a $50,000 deduction that would come off your taxable income if that building meets or exceeds certain energy criteria. And again, same types of things. We're looking at the lighting, the insulation, the mechanical, meaning heating and air, to see if it qualifies. On both these programs, you do have to have a third party come in and certify the building. That's something we do here at our company. But if you do pass, there's some great opportunities there. The last thing I'll add on the 179D, Brian, is you can go back as far as 2006 on the 179D. So if you've got any developer friends, or if you yourself are a developer, have built any commercial space since 2006 and not taken advantage of the 179D, you may be able to go back and claim some of those deductions and bring them forward into the current year.
Erik, how can people find out more about you, get a hold of you? You mentioned that you do third-party search. Do you do them all over the country? I mean, what's your range?
We're a national company. We do studies and certifications in all 50 states. We're headquartered out of Salt Lake City, Utah. Best way to get a hold of us is through our website, www.costsegauthority.com. That's just COSTSEG authority.com, costsegauthority.com. My contact information is on there. We're kind of a unique accounting firm where this is all we do. We don't do tax returns here. If you call me and ask me questions about child tax credits or earned business income, I have no idea. I'm going to refer you back to your CPA. Anything real estate depreciation, real estate taxation, we're happy to help. Please use this as a resource, guys. We don't bill by the hour. We just want to be a resource for you guys and help save you some tax dollars.
What is your favorite hack or app?
So actually, one that I use quite often it's called OnX Off-Road. And so I recently bought my first truck. So you can't tell by looking at me here, but I'm 6'5", nearly 300 pounds. I've been driving a sedan my whole life. And a friend of mine said, Erik, what in the world are you doing driving a sedan? He goes, you need to get a truck. You'll never go back to a sedan. So I bought my first truck last year. And ever since I bought the truck, I've been going off-roading. And so I live here in Salt Lake. We've got beautiful Wasatch Mountains just outside of Salt Lake. And so this app will actually, I don't want to go too heavy on the off-road because it's a new truck. So I like just dirt roads that go up the mountains. I don't like going over boulders and all that stuff. I'm afraid I'm going to break something. But so this app will actually tell you and show you pictures of all the different trails throughout here and give you difficulty ratings and tell you how long it should take you and conditions and all that stuff. So that's one that I've used a lot as of late.
This has been a great conversation about cost segregation and how it works and how you can leverage it to pay less money to the IRS in taxes. And then also the energy credit information you shared has been really powerful too. So thanks so much for having this conversation with us today. It's been a real pleasure.
Mine as well. Thanks for having me.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com.